be going through audit and compliance, and specifically in the areas of risk, policy, mapping, and procedures, changing nature of the internal audit function, effectiveness of financial reporting standards, and synthesizing the Auditor General's report. So mainly, this is an area of audit and compliance, and this juncture allow me to call upon our presenter this afternoon, Mr. Andrew Rory, who, as I said, I don't need to introduce. So welcome, Andrew, and make your presentation.
Thank you so much, Bwana Gashagwa. Ladies and gentlemen, good afternoon. Yeah, I know we are starting when some seats seem not to be occupied. So I'm also managing a risk of time, but also the risk that some people will be out at this time. So if we have people out there, please get in so that you can be able to proceed. So I given the responsibility this afternoon to discuss on the audit and compliance. But to discuss on audit and compliance, we need to look at some perspectives, and one of them is to recognize that our audit is based on risk. Then also to recognize that audit has two levels. There is the internal audit, which is part and parcel of the organization and management. And we have the external audit, which is a supreme institution in any country, which provides oversight on the management of public resources. So this afternoon, ladies and gentlemen, we'll be able to explore three areas. First, explore the aspect of risk and risk management, a function of management, then also look at internal audit and the linkage with the risk activities of the organization, and then be able to look at the external oversight. So that's what we are going to look at, and I want to start with the first slide. In terms of the presentation, there's a caption somewhere here, which I believe most of us have seen. What is the interpretation of that caption? On the top right of the screen. Anybody who has seen this, and what does it mean? Anybody? Yes, there, please.
I have not seen it before, but I can only imagine that things, when they are falling, somebody stands in between to stop that fall. So the role of an auditor, that is what I'm seeing, and that's what I'm trying to describe. That their job is mainly to stop things going haywire.
Okay, good, thank you so much. Yeah, that's the right interpretation. He has not seen, but he has given us an interpretation of somebody coming in between, stopping things from falling. And so it means somebody must have seen things are not working and had to take a step to stop them. Anybody who has seen this used somewhere before? It's commonly used nowadays. I know there's a common one used with matchsticks, but this one is also used. I saw, yes, there's a hand there.
My interpretation, one is when you look at this side, things are in a mess. All things are falling, as he said, my colleague said. But this gentleman's purpose is to put them right. He's trying to put systems, all things right. In an orderly way, I would say.
Okay, good.
Thank you.
Thank you. There is a hand there. There's ready there. There, just back there. Yeah. No, back. You just get the lady there. The hand is there. You can say. Unfortunately, I am saying the lady because I can't know the name. Sorry for that.
You want the interpretation of the picture?
Yeah.
Okay, so what I see is that one, somebody is trying to prevent the work to be done, or the person wants to do the work. Like the person pushing the thing, meaning that somebody is trying to prevent the work. Or somebody is trying to push the how do you call it? The structure down. Yes, somebody is trying to push the structure down.
Okay.
That's what I see.
Good. Thank you so much for the interpretation, right? There's a hand? You have raised the hand, no? Yes, there's a hand here. We take that one as the last one.
Thank you. I imagine if that person was not there, all the sticks would fall down. One stick falling on the other one affects the next one and the next one.
So this one coming in is stopping the sticks from falling, the structure from falling, the damage being done. And this, if you see some adverts for COVID, they have been using this, yeah? That it takes that one person to stop what? Basically the impact. But nevertheless, you have picked it right, that somebody must identify or take note that things are wrong, and that person must put in place the measures to stop what? The damage being done. In most of the organizations we work in, the question has been, when do we realize things are not going as expected? Do we have mechanisms to detect? Do we have mechanisms to identify? Do we have mechanisms to rectify? So the whole thing we are going to cover this afternoon is to check that are we able to identify when things go wrong? Are we able to detect any unusual aspect in our processes, in our activities, in our organizations that may adversely affect the realization of our objectives? Are we able to put in place mechanisms to rectify and take us to what is expected? So this afternoon, we want to look at risk policy, mapping and procedures. And the first thing we need to look at is risk. And I don't want to go through the whole definition of risk and what happens when things are wrong. But let's appreciate that the concept of risk is very simple. Because when I'm looking at risk, I'm looking at the possibility that an event will occur, and when that event occurs, it will adversely affect the achievement of our objectives. So the question is, what is this event which we need to take care of? As we are speaking and sitting here this afternoon, in your organization, which is that most feared event? Or which is that event which will make you rethink your processes? Which is that event would make you reevaluate your culture? Which is that event that would make you not survive? Because if something adversely affects the achievement of your objectives, then technically that is something everybody should be working to stop. Otherwise, our organizations will not achieve the mandates for which they were established to do. So that event, and that's what we may call the risk number one of your organization. The risk is wider. It's not only financial. You know, because we are talking about PFM, we may tend to look at risk from the financial perspective. But in all our operations, all the organizations here, you have got different mandates. What is that may happen that will affect your mandate? And that's something you need to worry about and put in measures. Then also, there's an explanation that is the chance, meaning that risk is a probability. It can occur or it may not occur. And always you must evaluate the probabilities. There is a likelihood of something occurring. So this likelihood probability varies from one organization to another, and it varies from one period to another. The probability of something happening today would be different from what will happen tomorrow. That means that in management of the risk, we need to be very dynamic. It's not static environment you're dealing with. Yesterday, you may have managed the risk very well, but maybe whatever was not a risk yesterday has emerged today. And so in the risk, we have a lot of emerging issues. And when things go wrong, they actually sometimes go very wrong. Some of you know a very basic example, which you can relate with all of you. As your insurance of the car expired, anytime, the day it expires and you're not aware, what happens? That's the time somebody hits you. That's the time the policeman is checking. And all through he has never checked your car, but now he's checking. And he tells you, come out, it has expired. Do you have that experience? Yes. And so when you argue that I don't need to take insurance, the day you don't have it is when things go wrong. So you must always prepare. It's preparing for the unexpected, preparing for the unthinkable. And organizations must always prepare for that. We don't operate in a perfect world. So, but how do you prepare? If you have to prepare, there is something you must keep in mind. That risk comes from not knowing what you are doing. That's a quote from Warren Buffett. Of course, a name where you can relate with. Do we know what we are doing as organizations? We must understand our mandate, and if we manage it very well, then we can be able to reduce the risk. So, ladies and gentlemen, we need to evaluate a number of things. That the underlying premise in terms of risk management is that every entity exists to provide what? Value. I don't know. There's some moving back and forth. Okay. We are saying that all of us exist because there is something we are supposed to provide. And that's what I'm saying, we must know what is it that we're established to provide. And so all of us, we exist because there's something which we are performing uniquely as an entity of government, uniquely as a government, that we expect to deliver on. But we also realize that in whatever we do every day, we have to take and manage a few risks. There is uncertainty in whatever we do. There is uncertainty from the political side. We have a political risk. There is uncertainty in terms of your operations. You may have operational risks. There is uncertainty in terms of your cash flows, which may give you a liquidity risk. There is uncertainty in terms of the operations, which may give you operational risk or basically even a reputational risk. So the only thing we have to do is that let's check how much of this risk we can take and still provide what? Services. In the corporate world, they always say that the higher the risk, the higher what? The returns. But that's not always the case. You must take calculated risks, and those risks, you take them in a way that you still provide value. If you are not careful in management of the risk, you may also get into losses. You may get also into problems. So the question is, how do we take advantage of the opportunities, and how do we go ahead and survive? So uncertainty presents both risk and what? Opportunity. There's a very interesting discussion in Kenya and around the world. When COVID came, we all realized we cannot travel out of our countries. And surprisingly, that's the time we know people can be very innovative. Where were these manufacturers of masks before COVID? In your country, was there a manufacturer? They were nowhere. But now we had entrepreneurs coming up. So has COVID given us some positive side? Is there a positive side of COVID? Taking advantage of the risk? Of course, there are some positive sides. We can talk about that. So we must look at that. Change in technology. It really brings challenges, but we have been able to embrace what? Technology. We are talking about organizations, those who are in HR, managing the generational gap, the millennials and the senior citizens within the organization. It presents a challenge, but it also gives you what? Opportunity. I don't know whether you have had a challenge in managing the so-called millennials, the young ones within the organization, especially for those who get that they are too fast for us. But they are too fast. The question is, how well do we make good use of them? So everything we do, looking at the organization, there's so many challenges we must deal with. And so they give us a risk, yes, but there's also what? Opportunities. So let's not dwell on the bad side, but let's also see how we deal with what? The good side of it. Enterprise risk management enables us to effectively deal with what? Uncertainty and the associated risk and opportunity, enhancing the capacity to build what? Value. So, what is our thinking as the government? Our conceptual setup. One thing we need to appreciate that risk management is inbuilt as a continual improvement cycle. We are not talking about continuous. Continuous is just going one line up. We are talking of a continual process. What is this continual process? As you manage the risks, you keep on evaluating them. Whatever you evaluate, whatever decisions you make, you check how well they've been able to address the risk. Then you are able to move to a step. It's a kind of a stepwise movement towards your goal. You are not moving on one continuous line, but you are moving as you evaluate the risk, and you are able to manage it well. This one is inbuilt in our government policies and regulations. Most of the government policies and regulations, they do take into consideration the aspect of managing any eventuality, both the positive side and the negative side. That's why we have got laws in place. That's why you have got a disciplinary manual, because you know at one time somebody is likely to do what? To go against the norm. And how do you ensure you take them to the original position? So we have policies, regulations, the laws in place which are supposed to guide. We always say that, and I believe the legal people here, that the laws are not made for the bad one. They're actually made to protect the good ones, because they always start from the premise that everybody is good. Is that true? That's why they don't state them from the negative side, they state from the positive side, to ensure that we are encouraging good behavior. Ministries, departments and agencies, policies, procedures and what? Manuals. So you have got your policies, procedures, manuals and everything you do. All that you do is meant to avoid or give direction or guide, because policies is to solve a problem, to give direction, to guide. There are many things we do. Planning meetings, all the meetings you have, all the operations you have, the discussions, you are meant to ensure that you are managing a number of aspects. Management reports, all the reports you have, the internal component of the management reports, which we evaluate every day, every week, every month, every year. They guide you. And annual self-assessment. You always keep doing an assessment to check how well you manage risk. So risk is inbuilt in your operations. There is no effective leadership without effective risk management. And that's something we must put in place. That every time we talk about risk management, we must put in place an appropriate system to ensure that we are managing. Now, when all else fails, who takes responsibility? Those who are able to read there, the book says what? When all else fails, those who are around, what does it say? Government as the ultimate risk manager. When everything goes wrong, even if it's in the private sector, the government is called upon to do what? To take responsibility. Because the government takes the first step. The government takes the lead. The private sector thrives on the government. If the government is not doing well, if the public sector has failed, private sector cannot fix the country. It's only the public sector which can fix most of the things. In Kenya, you are familiar with many things. When things go wrong, you hear a common say, serikali saidia. Yeah? Meaning that when things go wrong, people call upon the government to do what? To come up and really take responsibility. Even the things where people should have taken responsibility. That's very important to take note. There is no way we can leave most of the things to the private sector. As we manage our affairs, as we manage all the processes, the government takes responsibility for most of the processes. So the government takes lead in most of the things which happen. The other thing we need to recognize is that we need a strong framework in managing risks. Now, what is the proposed way? One, all organizations need to have a risk management policy. I don't know whether in your various institutions or countries, it's a requirement that you have a risk management policy. In Kenya, I can speak on behalf of Kenyans here that it's a requirement that all public entities have a policy, a risk management policy framework. Do we have the same requirement in Ethiopia? Okay. In Uganda, do you have the same requirement? That entities must have a risk management policy framework which guides in the identification and a coordinated approach towards managing risks. I know this is a concept which has been there in the private sector for a long time, but public sector has to pick up because we also get exposed to risk. In every decision we make, there is a risk. So Ethiopia is required, Uganda is required. What about Ghana? Yes, a requirement that entities have got a risk management policy framework. Yes. Okay. Zambia. Yes. South Sudan. No? So the question is, even those countries where Ghana and Zambia, you said yes, have entities really complied? You will get the level of compliance is very low. In fact, a research which was done by Deloitte shows that I think they sampled around 5 countries, five countries, South, Central, East, West, North, and the rest. They said the problem they're facing in risk management is that in the government, there are some terminologies which are always very common. You know the terminologies. Under development, in draft, you know those terminologies. In progress, is being finalized. Which other terminology have you used? Which one? Ongoing. Are you familiar with those words? Yes. So that you can get in the public sector, something is under development for 5 years. It's in draft for the last 3 years. Do you have them that? So they have said there is policy, but you go there, it's under development, it's ongoing. We are polishing. Yeah? I don't know how long it takes, but those are good things which happen. Then we need to establish a risk management framework. And this risk management framework actually involves us having a risk register. How many organizations here have risk registers? Risk registers, which are up to date every year. How many of us have risk registers? Oh, you are not so sure. You know that's also a problem. How many? Let me check. You can tell me. So, very few hands, yeah? What does it mean to the rest? It's under development, yeah? Yes, it's ongoing. Okay, ongoing is better. It's ongoing. But you see, we are saying the framework requires that you have a risk register, which is up to date every year. So you need to think about that. Define accountabilities, because the question is, who is responsible for risk management? I'll try to go to the responsibilities later, but we must know who is accountable. We have the boards. The boards have a specific role. We have the accounting officers. We have the members of senior management and staff. We have the internal auditor. And of course, within the board, we have got audit committees for most of the countries. Maintain and improve what? Risk capacity. This is very important because the capacity to conceptualize, analyze, and evaluate risk may not be so universal to all of us. Some of it is so technical depending on the environment we are operating in. That capacity to conceptualize and basically work on risk management. Have you ever wondered why in the health sector, if today they did polio vaccination and they found one case of polio, what do? If they did polio vaccination 2 weeks ago and they got one case this week, what do? they will repeat the entire vaccination. Why? Within the health sector, they know that if there was a vaccination done and we found one case, it means that that vaccination was not what? Effective. And that means there are cases there, and they know, even if it's expensive for people in finance, the budgetary implications, but the impact of polio is irreversible. Because the impact is irreversible, then it means you must do the vaccination. Then we need the governance and leadership. And that's what I'm saying, leadership is very key. So when you look at the risk management framework, it's wide. It is a systematic way of doing things. In managing risk, there's a systematic way, right from establishing the context, knowing the reason why you must manage risks. Because we have had activities where management put in controls, but people don't understand why those controls have been put there. So that means it doesn't make sense. So we must establish the context. Why are you managing risk? In any case, should you manage risks? Maybe. Because sometimes it's expensive. So you must decide, why are you managing risks? Then you identify the risks. We must identify the risks, analyze the risks, evaluate them, and treat the risks. So it's a whole process, a step by step. Let people appreciate that there is risk in whatever we do. As we sit here, there is a risk. We must appreciate. That's why when we came in, we know there's a COVID risk. Then we said, let's do this. We must observe the protocols. We must do this. And everybody appreciate. Have you ever tried to do something and people don't see the reason? Then actually you'll be wasting your time. So anytime you want to say you are managing a risk, you are managing something which is likely to affect the achievement of your objectives, then let everybody understand why you are doing it. Otherwise, you may be doing it and you are on your own. And that's one of the hardest things, when nobody understands the rationale for managing risks. If it's the management of resources, let everybody understand why we have to manage what? The resources. If it's talking about climate change, I know we never used to cry about climate issues. Then it was like it's only going to affect the developed what? Countries. Are developing countries suffering from climate change? We are. It's things we should have understood and appreciate why we are doing that. Identification of the risk, there are tools you can use. I'll be able to expose you the tools very fast. Then you analyze the risks. Analyzing of the risks can take different procedures. Some of them are very scientific, some of them are very advanced, but you must do that. Then communicate over time, keep on looping back, checking that did you do the right thing, you monitor, review, and you keep on reporting. In treating of the risks, you have got 4 options in treating the risks. You can either accept as part of the practice. There are some things you do and you accept as part of the practice. Then you can put in place measures to reduce the risk. Sometimes back, we saw I think is it the aircraft from Germany where the pilot just decided to bring down. Then the aviation industry decided that to reduce the risk of that happening, because the pilot knocked out the other pilot, and said that in future when one person moves out of the cabin, you must have another one there. I don't know, that's a control measure, maybe it works, but it assumes the person who is going in is also a pilot. He knows what he or she will do when things go wrong. So you have to check that. You put measures to reduce controls. Yeah? That's why you have got passwords. That's what you have got what? Screening process and all this. Those are controls to reduce the risk. If you cannot reduce the risk, you can transfer the risk. That's why we have insurance. But also be very careful that transferring of the risk brings in sometimes third-party risks. And that's very important we note. Like now, ICT is the most hard area to control. The data management, your data can easily get into the wrong hands. Does it happen? It will happen. And we have to check that. Today, we use the internet. Maybe this internet is controlled within KSG. Sometimes you have internet out there, you don't know it's controlling it. Once you log in, all your information is taken. That one do happen. So you can transfer, but be very careful of the areas you transfer. Then lastly, you terminate the risk. So you can accept, you can reduce, you can transfer, or you can terminate. It's you makes a decision what to do. So what you need to do is you need to evaluate all the types of risks you deal with. The risk can be at strategic level, they can be financial, they can be operational, they can be compliance, they can be environmental. It's quite wide. The kind of risks your organization face are many. So we need you to look at the entire risks, what we call the risk universe. All risk types and categories across all business lines, functions, geographical locations, legal entities, and what? That could affect the organization. I believe this is all that I asked you, whether you have a risk register. Because the risk register addresses all this type of thinking. So it's not only financial, we need to look at the risks from the higher level up to the lower level. Why? The people who can manage risks are not necessarily following the hierarchical thinking. So when you look at risk management, it doesn't follow the hierarchy. The security at the gate, these people at the gate better know what happens than me. Maybe I can explain what's going on in the training rooms, but I cannot explain what goes on in ICT, what goes on in the hospitality section, what goes on in the dry transport, what goes on in the field, because different people understand the environment different. And so my advice is that let's give responsibilities of risk management to the various employees who are well placed to do what? To manage the risk. Because it's not necessarily hierarchical in thinking. So there are methods you can use to identify risks. You can use the more common one, of course, the functional approach, where you evaluate the risks in every function or in every department. That's a method which is commonly used. And so if you came maybe the School of Government, we are going to analyze the risks as per the functions. Maybe ICT, examination, training, research, consultants, that's as per the functions. But you can also analyze them as per the departments. That's the most common one. However, we have other methods, environmental scanning, where you use the SWOT, the strengths, weaknesses, opportunities, and what? Threats, the SWOT analysis. You can use the PESTEL, the political, economic, social, technological, environmental, and legal. You can also use objective-based risk assessment model. This is a very important one, because if you take that approach, you are actually focusing on what can happen and you don't achieve your objectives. So you look at your strategic plan and you say, key result area number 1, this is what is there, but what is likely to happen that you don't achieve that result area? And that may start from a very high level, like now the vision. What may happen that you don't realize the vision? And remember, the vision is at the strategic level. Then you check the key result number 2. What does it say and what is likely to happen which will affect you? So the approach organization uses vary. Some organizations may use the balance card approach with the 4 function areas, looking at the financial, looking at the customer and stakeholder focus, looking at the internal processes, looking at the organization capacity, or what they call the learning and growth of the organization. So you may look at the 4 functions or the 4 aspects within the balance scorecard. So I don't know, which commonly do you use in your countries? I know Kenya, it's a mix. I've seen more of number 2 and number 3, but also number 1 is currently being used by a number of organizations, but most organizations use the functional approach, and also they are using the objective-based risk management model. Which is the common for most of you? Those who have done the assessment, which one have you used? Anybody? You have used 1 and 1, 2, 3. Then you didn't use the balance scorecard. Okay, good. For him, 1, 2, 3. Another person? Those organizations you have identified risk? Yes? The first one? There? 3. The functional. The functional, and this is the most popular one, I say that, but every organization you must check the one which brings out your concerns. You're saying which one? 1 and 2. Environmental scanning and objective based. Okay, yeah. It's easy actually to combine the two, because when you look at every opportunity, you do the SWOT on it and you're able to assess. So every organization will pick. There is no universally agreed way, but the key thing is that you must identify all your risks and you rank them. So once you have done that, we move to your risk management. And we are saying in your risk management, what we are saying is identified risks are evaluated and rated. So what does that mean? When you have identified the risks, you will evaluate them and rate them based on what management understands as the environment. Now here, when you are evaluating them, you look at what is the probability and what will be the impact. So when you do the probability or the likelihood versus impact, then you can say this is high. And that's the time you hear most people talk about the risk matrix. And the risk matrix varies from one country to another, or from one entity to another, because it is based on existing what? Existing controls. If you have controls, you can say high, medium, low. So you say high is 3, medium is 2, the low is 1. What is the impact? 1, 2, 3. Then you do 1 times 1, 2 times 1, 3 times 1, then you have a matrix. So in a matrix of 3 by 3, the highest risk will be what? 9. And so you say 9 is very high, and 9 need to be shown or known by the higher management, the top executive. You say maybe 6 to 9. Then you say 3 and 4 can be handled at middle management, and then 1 and 2 is handled at the lower level management. That's how you decide. But all this is based on what? It's based on the controls you put in place. We know there is, like now this is an institution, let me use that example. The institution is, which may affect us, is that the examination may be compromised. So what have we done to avoid compromising the examination? Then we say maybe in terms of the exam processing, these are the procedures, all the way up to invigilation of the exams. Then somebody will look at them objectively. Are those controls going to give us assurance? You will say yes, then the likelihood of happening is not so high. But remember, any compromise of the examination, even if the likelihood is not high, the impact will be what? Very high. So the impact will always be high, especially for the strategic level risks. So you develop what? A risk register, and then we link now with the internal audit department. And we are saying the internal audit department, sorry for that, that the internal audit department is responsible for providing assurance on what? Risk management, including the risks associated with assets and what? Liabilities. So now At the top level, we are bringing in an office of what? The internal audit. And the internal audit becomes critical in the management of what? Risks. But remember, for them is to give assurance. Who identifies risks? We said very clearly, identified by senior management. So the senior management, or generally the management, identifies the risks and is able to say how they're going to control and manage those risks. Having said that, then risk management, then who is responsible? This is the question we need to handle here. Who's responsible? If we are talking about risk management in the organization, who takes responsibility? Eh? Management. The board. Okay. Okay. Good. The board takes responsibility. Management takes responsibility. Okay. Good. Every person's responsibility. Okay. So it means we must look at where. So the overall responsibility may seem to go back to this. Who supervises the internal audit? That's where the starting point is. Who supervises the internal audit? Eh? The board. I need a mic because we need to get the experiences here. Who supervises the internal audit? Okay, there, then start from Mr. Karich there. Please, I know Karich.
Well, operationally, you find that that is the responsibility of the CEO. And then, of course, when it comes to now audit committee of the board, then it goes to the committee of the board, and that is the board. So
Okay.
it depends on now at what level are we discussing where this person reports to and the two-tier responsibilities.
So operationally, you are putting it at the CEO. Functionally,
Operationally to the CEO, functionally to the board.
okay, so you are apportioning the responsibility between the CEO and the board. Okay. Yes, this hand there.
In the case of government of Uganda, each ministry has an internal audit department, but we have an internal auditor general who sits at the Ministry of Finance, supervising the various internal auditors in the different MDAs. But within each MDA, if it's a ministry, you have the permanent secretary who's an accounting officer who oversees the work of both the internal and external auditors within the ministry.
Okay. Well, there is the permanent secretaries, the ministers, then there's the external auditor who comes in late. We have to look at how the lines of defense work then. Who appears where? And that's very important because internally still, the accounting officer in the ministry is what? The PS. And so the accounting officer has that responsibility. But remember, even the structure which has taken in Kenya is that the internal audit actually reports to the CS technically, because the audit committee reports to the cabinet secretaries. But those are now structures, institutional arrangements in countries which may really vary. Yes?
Yeah, in Ghana, every ministry has every ministry have internal audit department, and in every department or unit is headed by a director. If there is no director at that time, then there will be a head who is almost equal to the director. before we have the Auditor General.
Okay.
Thank you.
Okay, thank you. So that's again a process. The Auditor General is out of the ministry, but we have now the directors and the accounting officers within that. Good. The hand is here.
Thank you very much. I think I would say that both the CEO and the board needs to take responsibility. One, because the CEO is supposed to ensure that all the structure has been put in place, all the registers have been maintained, and because the CEO supervises the department, these departments are responsible for ensuring that risk is managed. And at the same time, we have said that the internal audit reports administratively to the CEO and technically to the audit committee. So in that case, also the board takes responsibility because it directly supervises the internal auditor.
Okay. Good discussion. You can see the perspectives going around the accounting officers and the audit committee, the audit committees or the boards, because in state agencies, audit committees in where? In the in the board. But when you go to the ministries, you may get that audit committees are not part of the organization. They may be outside. And that model means that the audit committees also take a fair share of the management. So, governing body or the board of directors approving the risk management policy, fraud prevention policy, and implementation plan. So they take a share in that. The audit committee, which is within what? The board or outside, reviewing and recommending disclosure on matters of risk in annual financial statements and on all annual report. Accounting officer, championing the effective management of risk, and this person is within the organization. Management, identifying risks and implementation of appropriate measures to manage such risks or anticipated changes in impacting on the entity. Staff, identifying and managing risks as part of their everyday business, evaluating them promptly as and when necessary. And then the internal auditor give reasonable assurance through the audit committee, the state of risk management, control, and governance. So what does that mean? The responsibility is shared across what? The entire organization. But however, we take note that the board and the internal audit tie together in giving us the assurance. But the person who does the championing and ensures this risk management is who? The CEO. Where we can put it at the level of the CEO because management and staff are under who? The CEO. So the CEO takes responsibility in identification and management of what? The risk. But the board gives us assurance that the CEO has actually identified and managed the risks appropriately. So that one tells us that risk management affects all of us in the organization. If you took that into consideration, it means that in terms of risk management, all staff need to be explained to, all staff need to understand the context within which we are managing the risks, and all staff need to understand that if there is any deviation from what is expected, then we need to put in place measures to ensure that that is controlled. So risk cuts across a number of areas. So it's not financial, it is in every operation, in every activity, in every objective of the entity. Now, what we need when we are saying approving risk management policy, it means every government entity must have what? A risk management policy. How are you managing risks within your organization so that the auditor can give us assurance that you have done the right thing? So, The institute, and I'm tying now internal auditing and what? Risk management. How does those two come together? We talk about the governing body, accountability to stakeholders for organizational oversight. This is where the board is. The board is the governing body. The audit committee is in the governing body. So management actions including managing risk to achieve organizational objectives. The first line roles which management must do is basically provision of product services to clients, but they manage the risks. The second line of defense is expertise, support monitoring and challenge on risk-related what? Matters. In the organization, all the various people we have put into the organization, all the employees of that organization, all the management must be able to give us some assurance that the risk has been properly managed and is being evaluated. We have internal audit who gives us independent assurance. The independent assurance, and we call them the third level roles. Independent and objective assurance and advice on all matters related to achievement of objectives. Then out, after the management has done that, you have the out person, who is the external auditor, external assurance providers. And all of us, that's why you brought in the element of the auditor general, which is very important because the auditor general comes in after the internal processes have been well managed. So that's what is called commonly the three lines model of management of that. So what are we looking at? You have brought in the internal auditor. So the second level, who is this internal audit? And the internal auditor is part of management. But a number of things have been said about this. In most countries, and I think that's what we have been able to check right from when we started on Monday, that in most countries, internal audit is a legal requirement for public sector entities. Ghana was saying in departments they have got what? Internal auditors. I think the same applies in Kenya. Ministries have got internal auditors. State operations, state corporations have got internal auditors. Is it the same case in Uganda? Is it a legal requirement that every entity has an internal audit? It is assumed that all of the entities must be able to observe that. So when you look at your countries, you realize that the internal audit, and I want to say, being a legal requirement, it means that it's embedded into your organizational structures. It's part and parcel of your employees. But management of it will be different. In Kenya, both the national and the subnational entities are all required to have what? Internal audit department. And more of it, you will realize that in most countries, the internal audit department is actually managed through the treasury. Maybe in the subnational level, the treasury there, and in the national level, the Ministry of Finance. Then what actually is internal audit? And it will bring most of the things you have said: independent, objective assurance and consulting activity designed to add value. So when you look at internal audit, it's more about how we manage our activities. How do we ensure that the internal audit is not about the watchdog, the policeman in the organization, but it's a person who is there to interact with the systems, to interact the processes, to interact with both financial and non-financial, and be able to give value. Some processes require somebody to keenly look at them and give you a thinking on how you are managing your operations. And that's why you say to add value. As a manager, you need to consult the internal auditor in most of the things you do. And the internal auditor in their profession, well guided, they're supposed to advise you on operational efficiency and effectiveness of your systems, of your structures, of your activities, and so that you are able to provide value to the, basically to the country, or basically provide value for your existence. So you realize that the internal auditor cuts across a number of aspects. They are supposed to review and evaluate activities and processes, including performance, budgetary performance, financial management aspects, that's quite wide, transparency and accountability mechanisms, and processes. And we have already said, give reasonable assurance through the audit committee on the state of risk management, control, and what? Governance. And we also agreed that they are supposed to review the effectiveness of your both financial and non-financial. I know this has been a debate because we are coming from an era where internal auditors focused more on financial. And most people looked at the external auditors as the ones who looks at the organization. Now what we are saying, a shift of it is that the internal auditor exactly actually does the same things as the external auditor, but the only thing is that the internal auditor is there within the organization. And so we expect them to look at the entire organization. We have had complaints that why is the internal auditor focusing on things which are not financial? Should the internal auditor focus outside financial? If you look at the mandate, transparency and accountability systems, processes, policies you put in place, the internal auditor is supposed to carry out an evaluation and give that assurance. When you give financial reports, the internal auditor is supposed to check them before even they go to the external auditor. The question you have had most of the time is the effectiveness of the internal audit. There are quite a number of things that the external auditor picks, and we ask, why was the internal auditor not able to pick them? And so management is supposed to strengthen and cooperate with the internal auditor. The problem with management, and that includes all of us, we don't take internal audit seriously. What we take seriously is what? External audit. That's the reality. In Kenya, I always have this common saying, we have always the internal auditor around, nobody talks about the internal auditor. But when we have external auditors, even clients will know. If I come to your organization, I'm told auditors are around. Auditors are around. Why? That's the time you are concentrating maximum to deal with the external auditor. Yet you have the internal auditor who should be there all the time. How do we respond to management queries by the internal auditor? Somebody just writes there, this is noted. Do you write that way to the external auditor? The external auditor, you will explain everything. I like the way you handle them. So the question is, let's evaluate that the internal audit is there to ensure that we operate as we are expected in terms of our operations, in terms of the management of our organizations. The last part here is a debate we must have. Formerly, the internal auditor, and maybe we can share country experiences here. In Kenya, up to around 2005, 2003, 2005, the internal auditor was involved in most of the processes of the organization. There was a change which meant that the internal auditor does not do what we call pre-audit, because there is no way you can participate in the processes, then you pretend to be auditing at the end of the day. So internal auditors were actually removed from the system of managing and the system of basically reporting within the organization. They only come at the tail end. What is happening in the other countries? Any experience? Is that the same? Like now, our internal auditors do not interfere with the payment system. They only come at the end of the payment system. That's what's happening in Zambia? Yes? Please, let's have a mic there. There are two hands up. So as we get them to speak, can everybody stand up? Please let everybody stand 1 minute. Just rise up. As we get them to answer, rise up, everybody. Okay, rest, stretch, up, up, up. Okay, up, straight, up. Okay, side, backwards, left, right. Okay, can we drive down, down, down? Can you get to see your toes or touch them? Others are not doing that. Okay, rest. Up, breathe in, hold, out. Once more, breathe in. Okay, good, out. Thank you. Okay, you can now get seated. Let's have the mic, the two who are to speak.
Thank you. Internal audit
Yeah.
in our case in Uganda participates in the day-to-day management in that most of the financial activities are pre-audited by internal audit
Yeah.
before we pass payment to reduce on issues you would find at the end if there was no pre-auditing.
Yeah. Okay, so most of the things the internal audit has to approve them before they are paid.
So I think we in Ghana, we almost practice same thing with Uganda, because we also participate in the pre-audit. We do the checks so that we check them so that they do the right thing, so that even when we are coming to do auditing, it minimizes the risks. You get that? Thank you.
Okay, thank you. That is Uganda and Ghana. Ethiopia. Okay. Zambia already agreed with what we say in Kenya. South Sudan. Okay. Yes? Get a hand there. Yeah, just here, yeah, there. Thank you. Yeah. Get it on. Yeah.
I'm saying I do agree with, or we have the same system of the mandates of the internal auditor.
Okay.
Yeah.
Good, thank you. I think if we take Ghana and Uganda, we used to have the same, and we found that it was a bit not objective, because if this person has participated in the system, cannot come later and give us an independent assessment. And I think we had also issues in terms of some payments not going through because they were really delayed at the audit section. So now what the finance department have, they have a person who does what we call examination. They have an examiner who actually is able to look at those aspects that the audit expects. So we don't expect finance department to carry out the work of the audit. But it depends on the systems put in place. In Kenya, it was a bit hard until it was changed. Why am I putting this sentence here? Management, you may get, especially in Kenya, that auditors sometimes don't participate in the management meetings. And some of them have been telling you when they come for management meeting, instead of them appearing under the heading present, they say to be put under the heading what? In attendance. Because to safeguard independence of the internal auditor shall not have direct operational responsibility or authority over any of the activities they review. And consequently, then they should not participate in a number of the activities. But remember, they're part of management. For scheduled meetings, they're supposed to attend like management. But there are meetings which they think, or looking at the agenda, you may realize that the objectivity will be compromised, and in that case, they may not attend. You may get that if you're going to inspect a project, the auditor may not accompany you because the project is actually in their work plan to be audited. So if they went with management, it would compromise their work plan later because they are already part of management who went to inspect the project. So if you see that kind of thinking, it's because we expect them to exercise judgment in activities which are likely to compromise their independence. Are we together? So those are the likely dynamics you can see with the auditors because it's a process. So the internal audit planning, one thing we need to appreciate is that the audit work plan should be secured in the entity's budget. What does that mean? We are trying to say that when the auditors plan for their work in a year, then you should secure the auditor's work plan in the budget because the field work for audit may require resources. And when you talk about the audit work plan, this one includes both the audit committee and the secretariat. And that means even at the board level, we should have mechanism to safeguard the audit work plan. Then, risk-based audit assessment. The audit which is being done currently all over the world, most countries, audit is supposed to be risk-based. So if you don't have a risk management policy, if you don't have a risk register, then the audit is being carried out of opinion or perception because there is no objective guidance. And that's why we have problems. When things go wrong, we will ask ourselves, where was the auditor focusing? The auditors should focus on what is the perceived risk areas. And so from your risk assessment, the auditor will focus the effort in the considered risk areas. However, the core mandate, even if it's not considered risky, should always be audited because failure to achieve the core mandate, then it means you are not in business. So the audit is risk-based. If it's very high risk, remember your efforts will be focused on the high risk areas. That's why we are talking about risk and audit, because audit is risk-based. Agreed engagement procedures. This is a very important area. Why are we saying this? During audit, there is an agreed standard procedure. The audit have a work plan. The audit will give what we call audit notification, or they give you that notification that they're coming to audit for a given period, and this is the scope. If you are a senior manager here or a CEO, you are required to attend entry meeting with the external auditor. What does that mean? If there is an entry meeting with the internal auditor for the auditees here, members of management, then attend the internal audit entry meeting. Agree with the internal auditor, agree on the scope, provide an enabling environment, let them carry out the audit. They will brief you at the end of the audit exercise in what they call what? The exit meeting. The same way with the Auditor General. So the engagement procedure for internal and external audit is almost the same. The only thing we want to encourage management and senior members of management here, please do not try to expunge information from the audit report. You know, that's a hard one. Why? Because the internal auditor will always discuss with management the report before it goes to where? To the audit committee. We can do that now, but the external auditor will still get the same problem. Meaning that the issues which were not properly addressed, they will come up. So what are we saying? Let's handle it with integrity. If there is an issue which has been raised, let's address them, because internal auditor is there to help us. Is there to protect us, is there to guide us, and is there to help us deter occurrence of some of the things. Audit procedures and approaches are guided by existing what? Existing internal controls. We already said the internal controls are put into place by what? Management. And we know internal control system is a process designed by what? Management to provide reasonable assurance about the achievement of the entity's objectives with regard to the reliability of financial and non-financial information, effectiveness and efficiency of your operations, and compliance with applicable laws and regulations. If we have to get internal controls to work, then we need a sound control environment which is created by top management by setting what? The tone. Meaning that for audit to work in any country, in any organization, top management must take responsibility. Audit cannot work if management do not take the leadership role. If you don't participate in entry and exit meetings with the Auditor General, for auditees here, you don't participate in the entry and exit meeting with your auditor internally, you don't take seriously the auditor's report, then that cannot assist us. If you put in controls and the first person to run down those controls is you, then it doesn't work. So if we put controls, we must be the custodian of those controls, evaluate them every day. If you say we are going to stop this, be the first one to read in stopping that. If you are saying this is the procedure, be the first person to follow the procedure. It's not easy. Those things are hard. I always use a very simple example that sometimes back I was evaluating an old system. I know those who are in HR know that we have had many systems of HR. The clock-in systems where people sign in the morning and sign out in the evening. Then in one organization, they brought in the swipe cards. And I found that the manager who was in the strategy table designing the implementation of the swipe cards is the one who had left the swipe card with the cleaner. The cleaner's work was to swipe in the morning on behalf of the manager. So would that one work? No. All of us will leave the cards with the cleaner. They swipe for us in the morning. And that's what happened at the end of the day in that organization. So the tone from the top. There are 4 types of controls. I'll not go through them. I'll just highlight. We have what we call preventive controls. Attempt to deter or prevent what? Undesirable events from occurring. They are proactive controls and that prevent errors. So in terms of all the things we do, I told you it's not finance. Segregation of duties. One person should not be able to carry out responsibilities from phase 1 to phase 10. You must be able to separate. Some of it is guided by the industry norms. Proper authorizations. Who has that credential? Who is able to authorize what? Who is able to give permission? All those must be well put down. Adequate documentation. Documentations are very important in terms of ensuring that we prevent some of the things from occurring. And lastly, fiscal control over assets. That's why you have got security. That's why you have got locks. That's why you have got PIN and passwords. Though I fear that those PIN and passwords, some people just write them somewhere and they're used. Those are the things which happen. Or you trust your employees so much until you do what? You give them your password and PIN. They will do it well today, tomorrow they will do it well for you. So just know whether they're doing it for the organization or for you. It's very, very, very good. Some of you have trusted some of your employees' signatures. There is a signature when you see, you say this thing is right. One day that signature would not be right. Do we have those cases? Yes. Even you are trusted by some people and they say, once he has signed, things are good. No, that's why there's different levels of authorization. Detective controls. They alert people after or before the unwanted event. They are effective when detection occurs before the material harm. So if you have got detective controls, they should be good to detect that something has gone wrong. They provide evidence that a loss has occurred, but do not prevent the loss from occurring. And that's why we have got review and analysis, variance analysis, reconciliations, physical inventories, audits. All those are to detect. Remember, you are doing them after something has occurred. So they are supposed to detect unique numbers within the system. If the number is unique, then it means that number can only identify one person. Detective controls don't work, especially at individual levels. I always used to ask the banks, why are they sending the bank statements to their clients? You know, nowadays some of them have stopped. How many of you used to check your bank statement when you're given? If I deduct from your pay slip, in fact, even giving you a pay slip, if I deduct 1,000 from your pay slip, Kenya, would you know? If I deducted $1 from your pay slip, would you know? How many of you will know that I've deducted $1? Assume I deduct $1 from every employee. How much money do I create? And there's an organization where in the HR system, the payroll accountant actually decided to deduct every employee. Just some minimum amount. Yeah. And they were deducted and it's directed to his account. Comfortably. I'm not saying it has happened to you, but just know. Corrective controls, they correct the negative effects of the unwanted event. They are designed to fix problems once they are found by the detective controls. They are designed to find the cause of the problem, correct the result of that problem, modify the system to keep the problem from not happening, minimize the impact of the threat, and remedy what? Problems discovered by detective controls. These are controls which we are going to put in as members of the board and management so that you are able to restore the original position. Corrective controls actually should take you to the original position. Some of the corrective controls work within also a control environment. I have a friend, I used to ask the friend, do you back up your computer data? He told me yes. By the way, in your organizations, where is the backup? Do you know where it is? The backup is in the same building where you operate from. I've seen in Kenya when audit queries come and organizations feel things are bad, they burn down the building. So everything disappears, there's no evidence. So where is the backup? It's a big issue. So this guy tells me he's backed up the computer. Then the external hard disk and the computer are in the same bag. So when he lost the bag, he told me, I've even lost the backup. So how do you assist this person? So where is your corrective action? Just think about it. Lastly, the higher level directive controls, they cause or encourage the occurrence of a desirable event. Executive can use directive controls. You direct policy and procedure manuals, employee training, job descriptions, staff, disciplinary manual, all those are the things you direct. You use a policy to give direction. So directive is basically to cause something to happen or to encourage. The board level directive controls do work. CEO level and managers, heads of department, you can use directive controls. They can work. You enforce them. You can push them down if you want when things are not working. But that's not the thinking that you need to put there. So there are 4 types of control. If you get them right, then that is good. But make sure that all controls are continuously monitored and evaluated for effectiveness. Some of them may not be effective. They have been put there as a procedure. You remember this case we are told of a military camp where they used to go do the concrete, then the animals come at night and they destroy. Then one of the military guys decided that from there henceforth, there will be somebody who will be keeping guard there. So that procedure continued, and nobody asked why people are keeping guard on a concrete, which had even dried for many years. You have heard of that story? Yeah, some of the controls are redundant. They don't make sense. So you must evaluate and know whether the control is making sense or not. So I don't want to go to the inherent limitations when you do it, cost-benefit analysis problems. You don't put a control which is more expensive than what you are controlling. Abuse of responsibility, especially senior management, are very good. They abuse that, and yet they put the systems. Corruption is a big issue. Audit, we cannot talk about audit and risk without talking about corruption. Those are part of the risks you need to manage. Limited coverage. Some of the controls we have are actually directed towards what? Routine transactions, and they forget the transactions which are very key. And the last three, human error. Human is the largest, single most contributor to abuse of systems. We create systems and we can abuse them. And so the best thing is that make people understand why you're putting systems. Now, the last part is audit, and that is a straightforward thing. Reporting audit issues I've already said. How is it reported? Internal audit report. Give the same weight to internal audit report as you do it to external audit. I know for the external audit, in most countries, the report ends up in Parliament. Is that the case in Ghana? The external audit report goes to Parliament? Yes. Zambia? Uganda? Yes. And that's the time the parliamentarians call you for a cup of tea. Is that true? Yes. They don't, that's the time they use the word that they have summoned you. So the internal auditor report, if the internal auditor has done the audit, it gives what we call audit queries. And those audit queries need to be answered. For the external auditor, they give what we call what? A management letter. And that management letter need to be responded to within a fixed timeline. So it's good to appreciate that in audit we have got two levels, the internal audit and what? The external audit. So the last part is that there are many types of audit. Please, in your tour of duty, avoid number 5. The rest are okay. You know what number 5 means. If you hear about forensic audit establishes what? Fraud, corruption, and other financial aspects. And that means that this one actually goes to prosecution. Because fraud and the rest, forensic audit or forensic report is a report to the court. Usually, all of us undergo what we call annual financial audits, which is certification audits, and the Auditor General gives what? An opinion. Periodic compliance audits, this evaluates the effectiveness of the risk management. That one you can do even internally. Control and governance process in state, and that's actually the same periodic. Then number 3, performance audits. They examine the economy, efficiency, and effectiveness. That's what we call value for money audits, and that's straightforward. And number 4, forensic audits, which is actually fraud and corruption aspects. Procurement audits are more straightforward. You did procurement yesterday, and procurement is to check that you have done your work within the law. You are procured within the law. IT systems audit also is done, and this one for most organizations, your internal auditors may not have a capacity to do this. So sometimes you are forced to hire the external experts to carry an IT systems audit. All audits examine what? Compliance with the laws, regulations, and standards, which we have been talking of since Monday. So the last part, which we always do to make it easier for you, is that the external auditor gives what we call what? Audit opinion. That is my last part. Now, for those who are not finance, this is where English is not good, yeah? You see, we are saying what? Unqualified opinion. When you use the word unqualified, in the normal English, it should be considered to be not good, yeah? But from the finance, you hear of the word true and fair. We cannot say correct because you cannot establish the correctness at a given point. So, the unqualified opinion is the best opinion by the external auditor. If you get this, it means your financial statements are good. The accounts give what? A true and fair view. The second one is called qualified. Qualified, it means except for. It means all that you have done is good except for. There are some things which you have not done right. And those may be things to do with policy, the manner in which you have carried your activities, the manner in which you have reported. But that one does not affect the soundness of the financial statements. Number 3 and number 4, which I want you to avoid in your tour of duty. If your organization has adverse and disclaimer, then something is wrong. Adverse, it means what? The financial statements are not fairly stated. There are so many fundamental misstatements, the accounts, that they are completely wrong and misleading. And if you cannot avoid number 3, then please avoid number 4. Number 4 says what? I'm not able to express an opinion, meaning you are on your own. So if the auditor says you are on your own, what are you doing, office? So avoid a disclaimer. So the function of the audit committee is to support what? Management, accounting officers, boards, and board chairs by monitoring and reviewing the risk control, governance processes, and have been established in the pursuant of the board. And audit committee functions and relations are outlined in the audit committee charter. I want to stop there and let's finish there. There's a good picture to keep you entertained. I don't know who is to take responsibility here. Who is taking responsibility? The gatekeeper is asleep. And the resources are being embezzled. So, thank you so much, ladies and gentlemen.
Okay, thank you very much, Andrew, for that wonderful presentation, which has ended up with something very interesting, which we can be able to all see. So this time we take this opportunity to welcome reactions to Mr. Rory's presentation. We can get questions or comments which we may have on or regarding the presentation that we have just received from Mr. Rory. So who goes first?